Let me ask you something. If an asset that barely moved for decades suddenly nearly triples in price within 3 years, what exactly is changing? In January 2020, gold was trading at around $1,580 per ounce. A standard 1 kilogram gold bar, 32.15 ounces, was worth approximately $50,000. That was before lockdowns, before stimulus checks, and before the largest monetary expansion in modern U.S. history. Now look at the screen today. Gold has pushed past $5,500 per ounce, lifting that same kilogram to roughly $176,000, same weight, same metal. So what changed? This is the uncomfortable question most people avoid. Did gold really become more valuable, or did the US dollar grow weaker? Gold did not invent new technology. It did not discover a new industrial use. It did not suddenly become scarcer overnight. Since 2020, the US money supply has expanded at a record pace, federal deficits have become structural rather than cyclical, and real interest rates have spent long stretches below the inflation rate. That combination guarantees one outcome. Each dollar now represents a smaller claim on real value than it did before. So when people say gold is soaring, are they reading the chart correctly, or are they watching the dollar quietly lose purchasing power? Because when a non-yielding, historically stable asset outperforms stocks, bonds, and wages over a 3-year period, that is not a vote of confidence in gold, it is a vote of no confidence in fiat money. Markets do not issue press releases, they reprice reality. And this is why this matters to you. This move is not just about returns. It is about trust. Trust in monetary discipline, in long-term currency stability, and in the idea that tomorrow's dollars will behave like yesterday's. Before we break down why this loss of trust is accelerating and what history suggests usually comes next, welcome to GE Economy, a channel dedicated to deep analysis of economics, finance, and market patterns. If you found this valuable, don't forget to like, subscribe, and follow along to gain insight before the next shift unfolds. So what is actually driving this move in gold and silver? Let's strip it down to mechanics, not opinions. The first and most important factor is the deliberate weakening of the US dollar through monetary policy. Beginning in mid-2024, the Federal Reserve pivoted toward rate cuts, even as inflation remained structurally above its long-term target. At the same time, other major economies moved in the opposite direction. The European Central Bank, the Bank of England, and several emerging market central banks either held rates higher for longer or raised them outright to defend their currencies. That divergence matters. Capital flows toward higher real yields. When US rates fall relative to the rest of the world, demand for dollars falls with them. This is not accidental. A weaker dollar makes US exports cheaper and more competitive globally. American energy, agricultural products, and manufactured goods become more attractive when priced in a declining currency. Historically, this is a classic policy response for heavily indebted nations, inflate away liabilities while stimulating external demand, but the trade-off is unavoidable. When the currency weakens, hard assets reprice upward. Gold, silver, oil, copper, anything finite and globally traded begins to rise in dollar terms. Not because it changed, but because the unit of measurement did. Silver, however, tells an even more revealing story. While gold is primarily a monetary asset, silver sits at the intersection of money and industry. Roughly 50–60% of annual silver demand now comes from industrial use: electronics, solar panels, electric vehicles, medical equipment, satellites, and military hardware. As of 2024, solar alone consumed more silver than any other single industrial sector in history. That means silver is being pulled in two directions at once: as a store of value during monetary stress and as a critical input during technological expansion. When the dollar weakens, investors move into precious metals for protection. When industrial demand accelerates at the same time, supply cannot respond quickly. Silver production is largely a byproduct of mining for other metals, which makes supply inelastic in the short and medium term. The result is exactly what markets are showing now: silver rising faster, with more volatility, than gold. This is not speculation. It is arithmetic. Falling real rates plus a weaker dollar force capital into finite assets. Gold reflects the loss of monetary confidence. Silver amplifies it, because it also reflects the physical demands of the modern economy. Now we arrive at the core issue, the one that matters more than interest rates, more than charts, and more than short-term price action. That is trust, or more precisely, the rapid erosion of it. Because throughout financial history, gold does not rise first when economies slow. It rises when confidence breaks, and that is exactly what the data, behavior, and capital flows are signaling today. Trust in governments has weakened as fiscal discipline disappears. As of 2024, U.S. federal debt surpassed $34 trillion, growing by over $1 trillion every 100 days. Deficits are no longer emergency responses. They are structural features of the system. Trust in the financial system has followed the same path. Since March 2020, central banks have demonstrated that liquidity will always be prioritized over stability and asset prices over savings. Banks were rescued. Markets were backstopped. Savers were diluted. That lesson was not lost on capital. Trust in media has collapsed alongside it. According to long-running surveys like Gallup, public confidence in mass media in the United States has fallen below 35%, near historic lows. Inflation was called transitory. Debt was framed as manageable. Currency debasement was softened into technical jargon. When official narratives repeatedly conflict with lived reality, rising rents, higher food costs, shrinking purchasing power, people stop listening. And when people stop believing what they are told, they start protecting themselves. That protection increasingly shows up in gold, not because gold pays yield, not because it promises growth, but because it promises nothing can dilute it. Gold does not rely on policy, credibility, institutional honesty, or future promises. It simply exists. That is why the relationship is so consistent across centuries. When trust goes down, gold goes up. This is not ideology. It is pattern recognition. By 2022, 2024, central banks themselves quietly confirmed this shift. For the first time in decades, global central banks became net buyers of gold, adding more than 1,000 metric tons annually, the highest level on record. These are not retail investors chasing momentum. These are institutions tasked with preserving national reserves, institutions signaling, through action rather than words, that trust in fiat systems is no longer absolute. This is what a trust deficit looks like. Not panic, not collapse, but a steady reallocation away from promises and toward permanence. The world is not pricing a single crisis. It is pricing a loss of confidence across multiple pillars at once: government credibility, financial stewardship, media narratives, and currency stability. Gold is not predicting the future. It is reflecting the present. At this point, a fair question naturally follows. If so much money was printed after COVID, why didn't gold explode immediately? Between March 2020 and the end of 2021, the U.S. M2 money supply expanded by more than 40%, the fastest increase in modern monetary history. By historical standards, that level of monetary expansion should have produced an immediate and violent repricing of gold. Yet for long stretches, gold remained frustratingly flat, hovering between $1,700 and $2,000 per ounce. That disconnect confused many observers, and it wasn't accidental. The first reason is simple but often ignored. Capital went elsewhere. During the same period that money supply was surging, crypto absorbed the speculative impulse that traditionally flows into precious metals. Bitcoin rose from roughly $7,000 in early 2020 to over $60,000 by April 2021. Ethereum increased more than 40-fold. For a generation of investors, crypto was perceived as a faster, more explosive hedge against monetary debasement. The result was a temporary diversion of capital away from gold and silver, not a rejection of the thesis, but a rerouting of it. The second reason is more structural. For decades, analysts have pointed to the role of paper, gold, and silver markets, futures, options, and unallocated contracts in suppressing spot prices. In the U.S. and London markets, the volume of paper claims on gold has often exceeded physical supply by multiples. This allowed large institutions to short precious metals aggressively, particularly during moments when rising prices threatened to signal monetary instability. The evidence is visible in repeated episodes where gold and silver were sold heavily during low liquidity hours, driving prices down without corresponding physical supply. What changed is not sentiment, but positioning. By 2022, 2024, central banks around the world quietly crossed a historic threshold. For the first time in decades, gold holdings surpassed government bonds as a preferred reserve asset for many non-Western central banks. According to the World Gold Council, central banks added over 1,000 tons of gold per year during this period, while exposure to U.S. Treasuries declined. Once institutions themselves became net accumulators rather than suppressors, the incentive to cap prices disappeared. Gold didn't fail to respond after COVID. It was delayed until the system was fully positioned. At this stage, the conversation inevitably splits in two: gold versus Bitcoin. Not as competitors in a short-term trade, but as rival answers to the same underlying question: what do you trust when the system itself is questioned? Both assets are responding to the same pressures, yet they represent fundamentally different generations of monetary defense. Gold is the old answer. It has served as a monetary anchor for more than 2,000 years across empires, collapses, and currency resets. When geopolitical risk rises, wars, sanctions, reserve freezes, gold demand reliably follows. That pattern repeated after Russia's reserves were frozen in 2022, an event that fundamentally altered how nations perceived sovereign risk. Since then, central banks, particularly in Asia and the global south, have accelerated gold purchases, reinforcing its role as a politically neutral reserve asset. Gold does not depend on electricity, networks, or software upgrades. It exists outside the financial system, which is precisely why it is trusted when that system is under strain. Bitcoin is the new answer. Launched in 2009, it was designed in direct response to the global financial crisis. Its core proposition is mathematical, not institutional, a hard cap of 21 million coins enforced by code rather than policy. No central bank can expand it. No government can devalue it by decree. Over the past decade, Bitcoin has evolved from a fringe experiment into a recognized financial instrument. By 2024, spot Bitcoin ETFs were approved in major markets, opening the door for pension funds, asset managers, and regulated institutions. Banks that once dismissed Bitcoin as speculative now offer custody, trading, and exposure through traditional vehicles. This is where the debate sharpens. Gold is stability without upside. Bitcoin is upside with uncertainty. Gold preserves purchasing power over long cycles. Bitcoin aims to redefine the system entirely. One protects against collapse, the other potentially benefits from replacement. That distinction is why opinions split almost perfectly down the middle. So, the open question remains, and it matters more than price targets. Over the next 10 years, which outcome is more likely? Gold at $50,000 per ounce, reflecting a prolonged erosion of fiat confidence? Or Bitcoin at $1 million, reflecting the emergence of a new monetary architecture? Markets haven't decided. Capital is hedging both outcomes. And that, more than any forecast, tells you how uncertain and how transitional this moment truly is. When you step back and connect all the pieces, a single message runs quietly beneath everything we've discussed. The current system is not sustainable. This is not a dramatic claim, and it does not require a collapse to be true. It is visible in the numbers. Global debt surpassed $315 trillion in 2024, more than 3 times global GDP. In the United States alone, interest payments on federal debt are now projected to exceed $1 trillion per year by the mid-2020s, more than the defense budget. A system that requires perpetual borrowing, perpetual rate suppression, and perpetual asset inflation just to function is not stable. It is conditional. History shows what follows conditions like this. Major monetary restructurings tend to occur not when systems fail outright, but when they can no longer be patched. The gold standard ended in 1971 not because the U.S. collapsed, but because the system had become mathematically unworkable. The Bretton Woods order dissolved quietly, then inflation revealed the cost years later. What we are witnessing now fits that pattern, not panic transition. This is why it is critical to understand that gold and Bitcoin are not causing instability. They are responding to it. Gold rises when confidence in policy discipline weakens. Bitcoin rises when confidence in institutions themselves is questioned. Neither asset forces governments to print money, run deficits, or dilute purchasing power. They simply measure the consequences of those choices. Blaming gold or crypto for financial stress is like blaming a thermometer for a fever. The repricing of hard assets is not a prediction of collapse tomorrow. It is a signal that capital is preparing for change, a reset in incentives, rules, and monetary architecture. Whether that restructuring comes through inflation, debt restructuring, digital currencies, or a hybrid system remains an open question. What is clear is that the old framework is being stretched beyond its design limits. That is the real message behind the gold and Bitcoin debate. If you see it differently, or if you think the system can stabilize without a major reset, leave a comment below. I'm genuinely interested in hearing where you agree or disagree on what comes next.